Stocks rose across the board here in the United States on renewed enthusiasm that we might actually get a stimulus package signed. It seems like both parties are getting a little bit closer to an agreement here, so we should find that out in the short term. In the meantime, it was good to see the NASDAQ Composite finally break its loss streak. It had lost 5 days in a row, finished slightly higher here today. However, we did have Netflix coming out with their earnings after the bell, and they missed expectations by about 19%, and their stock was down, I think it was about 6% the last I checked. So there might be a little bit of pressure there on the NASDAQ tomorrow morning as a result of that. We actually see some bearish postures on a lot of our indices, with the exception of the Russell 2000, which retains its bullish posture. So we'll talk about all of that. Then we'll get into our trade application example, where I wanted to focus on a bullish trade on a technology stock. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It is October 20th, 2020. First of all, if you're new, remember to go over to YouTube, click subscribe on our channel, check out our description area where you can sign up for our email distribution list. We're also heavy users of Twitter. I'd encourage you to follow me if you're not doing so already. My handle is @BrandonVanZ, and we appreciate those of you that click like and retweet on our Market Outlook related tweets out there. And then last but not least, we have a presence on Facebook as well. Feel free to go to our group at that web address you see in that logo in front of you. All right, let's jump into our charts here. And as you can see, I've got chart 4B pulled up here in front of us for those of you that are premium market scholars that are following along at home. Remember, this particular chart setup is basically going to give us a bird's eye view of the 4 major U.S. equity indices out there, try to get a sense of whether there's any differences between them or whether they're all largely kind of traveling in the same direction. And as I mentioned in the intro, we do have one difference here, and that's the Russell 2000. Russell 2000 was only up 0.25% today, but notice the background color of the chart is different than the others. With yesterday's big sell-off, we actually went to a weekly bearish posture on the S&P 500, the Dow Jones Industrial Average, and the NASDAQ Composite. So while the Russell 2000 also sold off pretty strongly yesterday, it did not take away its posture. Notice that its green line on the market forecast, so that's what we're using to establish our posture, is still in what we deem the upper reversal zone. And so that is considered strongly bullish in that zone, whether it's rising or falling. You'll notice that the intermediate reading right now is at 87 and falling, but again, because it's above 80, it doesn't matter if it's falling or rising, it would retain that bullish posture in this particular case. So that sets up a follow-up conversation, which is, now that we know this is the only one that has a bullish intermediate posture, this is the only one we need to check to see whether we have a bullish intermediate confirmation signal, and the answer to that is yes. Notice that the red line on the Russell 2000 is in the lower reversal zone. You can see the reading right over here in the label. It says the momentum line is at 11 and rising. So since that's below 20, we know the red line's in the lower reversal zone on the same day as the green line is considered bullish. Now, while the blue line is technically not part of the bullish intermediate confirmation signal, we sometimes use that as a way to kind of help determine whether the signals are better or worse. And what we've noticed over time is that when the blue line is somewhere between 20 and 50, the bullish intermediate confirmation signals tend to work out a little bit better. And so that is the case here. However, it's really close. You can see that the blue line is at 23 and falling right now. Remember, the lower reversal zone is at 20. So again, we want to see them between 20 and 50. Kind of in the middle of that range would probably be the best. But nonetheless, at least we do have one example here of kind of a buy the dips mentality on still a strongly bullish chart at this moment in time with the Russell 2000. And remember, that low size factor has really been coming along nicely in recent weeks and months. It's something that we discuss regularly in my Wednesday morning factor-based swing trading class. So I'm going to have that conversation yet again tomorrow morning for those of you that are Premium and Plus members about which factors are leading and lagging. And we've really seen some good evidence here recently that the small size factor is doing quite well. So anyway, in terms of the other indices, you know, the other thing to point out is that despite having the weekly bearish posture on those other three indices, they still have green moving averages. And that signifies that price is above a rising moving average. Now, when you're looking at these 30-day moving averages here, they probably look more flat to you than anything else, and I think that's fair. But there is a slight curl up there at the end to account for some of that upward price momentum that we saw throughout the last month. Remember, a 30-day moving average, of course, is going to go back and look at the last 30 trading days. And during that time, we have seen a rise in stocks, even though the last, let's call it, 7 or 8 sessions have been mostly a little bit lower. On the whole, the early candles in that 30-day process have outweighed the more recent ones, and therefore we have a slight tilt higher in the moving average itself. So I think that's a healthier sign that we see right there. Now, I did mention that we had some earnings coming out here after the bell. Remember, we're in kind of the heart of earnings season right now, so we can expect hundreds of companies coming out in the next few weeks. And some of the bigger ones that reported after the bell tonight were Netflix. And as you can see here, Netflix has seen better days. It closed the session down 1% on a day when the market was up to begin with. It closed out 525. And currently in the after hours, you can kind of see where my mouse is here, the bid is 495, as is the ask. So we can anticipate that there will be some pressure on Netflix shares as they open up for trading tomorrow morning as well, unless we see some sort of major reversal in the after hours. And that does happen on occasion. Sometimes the analysts will all come out in unison and upgrade a stock or something along those lines. But given the fact that they missed estimates so badly, somebody was saying that it was the second worst miss that they've had in several years. So this was not just a small miss, this was a pretty big miss that I would anticipate that the analysts probably are not going to be upgrading it in unison in this particular case. So put that one on your watch list, see how that affects other stocks. Remember, Netflix is kind of viewed as a bit of a coronavirus play. Now, to be fair, Netflix had been doing spectacularly well in the years leading up to the coronavirus as well, but the general thought process there is that Netflix should be in a robust environment with so many people locked up in their houses with not a whole lot else to do other than watch movies. What that doesn't account for is how much money are they spending on content, and that has always been the bugaboo for Netflix, is they spend a tremendous amount of money on content to keep their viewers satisfied. So anyway, that one is under pressure after hours here tonight. Other stocks that reported after hours that are worth mentioning, Texas Instruments. This is a stock that some of you that have attended my dividend growth investing classes over the years should be familiar with. It's not an aristocrat, but it is a dividend achiever, meaning it's raised its dividends for more than 10 years in a row. And it's a rare tech stock that we can concentrate on when it becomes at attractive valuations. At this exact moment in time, it's actually closer to all-time highs than anything. You can see that it's trading up after hours. Last traded price was 152.50. It closed today's session at 150.83. So up, a dollar or two after hours. And so we'll see if it can take out that 52-week high here on that enthusiasm as soon as tomorrow. The other stock that is capturing some attention after hours is Snap. This is not a social media platform that I'm all that familiar with, but apparently there are plenty of people that really enjoy the old Snapchat there. You can see the numbers are pretty impressive after hours if you're judging by the stock price movement. Snap closed at $28.45. It's currently trading in the after hour session above $34. That is a huge percentage move after hours for Snap. And not only does that positively impact Snap, but I had noticed that there were a couple of other well-known social media platforms that were doing pretty well after hours as a result of what we learned at Snap there, including Twitter. Notice that Twitter closed the session at 46 bucks. It's currently trading closer to 49 after hours. You can see that nice upward ascent in the after hour session there, completely on the back of what happened with Snapchat. And then also Pinterest. I know Pinterest doesn't get a whole lot of press compared to a lot of the other social media platforms, but it's been doing really well this year. So don't fall asleep on Pinterest. It closed the regular session just barely above 45. It's currently trading $3 per share higher than that in the after hours session, again thanks to Snapchat. So that's your rundown in the after hours session there. Let's pop on over to the internet briefly. And I wanted to say thank you to those of you that clicked like for me the last time I did the video on Thursday. I had to laugh because you guys know that I like my nice round numbers, and I'm always striving to earn at least 100 likes from you guys that are watching these videos. And lo and behold, it was exactly 100 likes. So those of you that pulled your weight last time around for me, I really appreciate that. Remember, this is a free video. David and I try to do it as often as possible, and we're more motivated to do that if you guys are helping support us on social media. So if you want to see these videos continued on a daily basis going forward, we would encourage you to click like for us there to let us know that you appreciate those. So thank you to those of you that do that each and every day. It is noticed. Also, heads up that we didn't have a directional option strategies class today. David was feeling a little bit under the weather there, but I did teach my dividend growth investing class, and we concentrated on the healthcare space. So if you're interested in that rundown of a head-to-head matchup of two DGI stocks that are at attractive levels for purchasing, check out our calendar if you're a premium or plus member. I have not got the file back yet. The WebEx has been interesting to say the least here in the last couple of months with my classes. They have not been sending their files back to me until late at night. In fact, last night it was about midnight when I finally got yesterday's classes back. So do apologize to those of you that want to watch them a little bit earlier. It's kind of out of our control at that point. We have to wait for WebEx to send our files back. So at this moment in time, that dividend growth investing class is not available, but I'll keep on checking it throughout this evening, and as soon as it becomes available, I'll post it to our calendar there. Also, while we're over here on the internet, remember that if you're a premium member of Market Scholars, you always have access to our sector selector throughout the week, but I do share it here occasionally during these videos on YouTube as well. And wanted to show you our most recent ranking, which would be as of Friday evening. And we did see the three same sectors that were leading the prior week lead once again this most recent week. The difference is how they were ordered. The prior week we had materials in the number 1 slot. They fell down to number 3. Discretionary was at number 3. They went up to number 1. And technology basically just held the line there at the number 2 slot. Technically, the discretionary and technology areas were about as close to a tie as you could get. So those two are basically neck and neck for the strongest sectors at this moment in time. And that's something that's important for our trade application example a little bit later today, as I will be focusing on a bullish trade within the technology sector. So keep that in the back of your mind there as well. Of course, on the downside, once again, lowly old energy. While they have a few positive days here and there, for the most part, it has been a house of pain to be able to participate in the energy space here in the last few years. Let's get back on track with some of our Thinkorswim charts now, and let's come on over here to the 3 green arrows chart. This will be 4D for those of you following along at home. And we do have something new to report on this particular chart setup. We no longer have 3 green arrows on the Russell 2000. So as of today, you can see a new red arrow came in on the MACD histogram. So telling us that we've kind of lost some of that momentum. It's not bad, right? It's just kind of stalled out, right? We had this big move higher in the Russell 2000 from the low here on September 24th to the high here on October 12th, and then we just kind of been meandering sideways to slightly lower. So that was enough to kind of flip that momentum-based indicator back to a red arrow. Now remember, the other indicators, or I'm sorry, the other indices already had red arrows on those indicators. So really the Russell 2000, if you want to think about it a different way, would be considered the leader here because it was the last to finally give up its green arrow there. So we'll see how long that lasts. Remember that MACD histogram can come back over to a green arrow fairly quickly. In fact, An example of that would be back over here in July, where we had a red arrow. It flipped immediately back to that green arrow the very next day. And then a week later, it had another red arrow, flipped right back to that green arrow. So just because we got one here doesn't mean we can't regain a 3 green arrow status very, very quickly if we do see small caps rising here in the near term. The others have a little bit more work to do because there was a little bit more pressure applied to their charts in the last couple of weeks. In terms of the 1040 crossover method, remember this is going to be kind of our further back, looking back period. 3 years in length is each of these charts here on chart 4C for those of you following along at home. And the good news is we are starting to see more separation between the orange line and the blue line on that Russell 2000 chart. I've kind of talked about that the last couple of weeks, but it's important to reiterate that point because for a while here, maybe a month or so ago, it looked like those lines were pinching together where there was maybe a possibility of a bearish crossover on the horizon. But with the small caps kind of having some renewed enthusiasm here over the last 2 or 3 weeks, they've really kind of they were saved by the bell, and you can see that the separation is showing itself through the PPO line down below here as well. So again, for those of you newer to watching this video, the orange line will be the 10-week moving average. The blue line will be the 40-week moving average. So the orange line is more sensitive than the blue line, and we're looking for crossovers of those lines to determine what is our longer term trends looking like. And right now, with the green background color on all 4 of our charts, despite a little bit of turbulence in the near term, longer term perspective, we still have bullish trends on our hands here. All right, let's go ahead and do some 12 grid analysis now. And I'm going to come over here to our chart 5A, which is our asset class 12 grid. So when we're pulling this up here, you can see a variety of green and pink charts. And again, for those of you following along at home, this is chart 5A here. And when we're looking at this, you know, I'm kind of looking for a couple of things, either continuations in trends or reversals in trends. And, you know, there are certain things that catch my eye. One of them is interest rates. If you look in the lower right-hand corner of your screen here, this is the chart that will look at the 10-year U.S. Treasury yield. If you're following along at home on your Thinkorswim platform, you could pull it up under TNX. That's actually a nice looking chart right there, right? And we had a good bounce right off of that rising 30-day moving average here maybe 4 or 5 sessions ago. We are actually at a 3-month closing high on the 10-year interest rate. I know it doesn't sound like much, but given where we've come from, it's somewhat impressive. We finished the session. Remember, you have to take that decimal point and move it to the left one. So if you want to think about it from what the 10-year Treasury yield is right now, it's basically at 0.8% at this moment in time. Again, you're not going to light the world on fire by, you know, bragging at your next cocktail party that you gave the U.S. government your money for 10 years and they gave you 0.8% in return on an annualized basis. But it is a lot better than it was previously. And remember, a lot of areas around the world have negative interest rates, or at least they had negative interest rates. So anyway, there is an increase in interest rates that we are starting to see take place. Remember, the inverse of that, if you want to flip your attention now over to the left-hand side, when you're looking at TLT, this is an ETF that tracks long-term U.S. Treasury bond prices. So when interest rates go up, bond prices go down and vice versa. And we are seeing that kind of play out tit for tat here, where, you know, last week we saw this drop in interest rates down to its rising moving average. With long-term U.S. Treasuries, we saw a rise in prices up to its downward trending moving average. Some of you will recall that I discussed that in a video last week, that setting my assumptions up, I'm going to assume that TLT is going to fail in its advance right here because of that downward trending moving average. And so far, that has proven to be correct. We'll see where it takes us. Where we stand right now on TLT is what you could consider a horizontal support area. So, you know, if the bulls have an excuse to rally, this is it. If it slashes through all of these prior candles from earlier in October, you know, as soon as tomorrow or the next day, then you can assume that this downward trend will hold. until it doesn't. And of course, that's the whole point of watching these videos every day, because when things change, we try to inform you of them. And so at this moment in time, they are at a very precarious level there on long-term U.S. Treasuries. At this point, I'm going to make the assumption we're going to fail. In other words, TLT is going to break down to new lows and interest rates are going to break up to new highs. That's generally considered a positive sign for risk appetite. You're oftentimes finding that money is flowing out of U.S. Treasuries into the stock market when market participants are willing to take on risk. So generally speaking, that's a positive sign. Now, obviously, there's a lot of different variables that will go into it than just that, but at least that's something to consider as we're heading towards this stimulus package, and then, of course, the election coming up within the next month as well. In terms of other areas that have caught my eye, foreign bonds have been superior towards to U.S.-based bonds. That's something I've been talking about over the last month or so in these presentations as well. Remember, not all bonds are created equal, just like not all stocks are created equal. You know, Con Ed is going to be completely different than Apple Computer. And so you shouldn't assume that all bonds will be similar to one another either. There will be times where there are differences that are worth pointing out. And right now, it sure seems like if you're looking for you know, capital preservation in your bonds, you're doing a little bit better for yourself in the foreign bond market. And if you want to kind of buy those as a basket, as it were, you could use the proxy we're using here, which is BNDX, which is an ETF that has, you know, dozens, if not hundreds, of foreign bonds within it. So if you're going to dabble in the bond market, that might be an area where you're seeing your money retained a little bit better. Gold was up today. Dollar was down. Remember, that happens quite a bit. US dollar falling helps improve the prospects of commodities priced in those dollars. So both gold and oil were both up here today. In fact, we'll talk about this here in a second, but oil stocks actually did reasonably well today, and part of that, of course, is because oil itself was up today. One thing worth pointing out, we're kind of waiting on gold here, right? Been talking about this breakdown that we saw here at the end of September for quite some time now, and we still haven't really established dominance above that moving average. So right now, kind of the path of least resistance on gold continues to be to the downside until we start seeing a more enthusiastic push above those moving averages by bullish participants. So right now, that's just not happening. So we're in wait-and-see mode there with gold. With oil, it's kind of interesting, at least if you're using USO as your proxy. Notice that we do have an upward curling moving average all of a sudden. We haven't been able to make the claim that we've had a green moving average on USO since going back here to August. So that's something a little bit new that's just occurred in the last couple of days. We'll want to keep our eye on that situation right there. Okay, let's go ahead and take a look at another set of 12 grids now. And in this case, we're going to look at the sector 12 grid. This will be chart 5C for those of you that are premium and plus members following along at home. Now remember, this is going to be the market cap weighted version. We also have an equal weighted version. If you're looking for that under our chart system, it's going to be chart 5R. But generally speaking, our default view here during this presentation is using these market cap weighted ones. But of course, you have to understand the slight nuances that come with those as well, where you're going to have stocks like Amazon that have an upward sized effect on something like discretionary, and Apple and Microsoft are going to be huge impacts on technology, and Chevron and Exxon are going to be huge impacts on energy. But anyway, as I mentioned earlier, speaking of energy, it actually led the market today from a sector perspective. It was the only one that was up over 1%, as we saw that nice move in crude oil prices themselves. So energy finished higher by 1.18%. Again, be very careful there. Just because it was up one day does not make a trend. In fact, you noticed on the sector selector, energy was still dead last there, and there's obvious reasons why. Over the last 3 months, XLE is down 17%, whereas every single other sector that we're looking at out there is up. Now, granted, healthcare is barely up; it's only up 0.45%, but it is kind of weird to think that there are 11 sectors out there. There's only one that's down, and that one that's down is down almost in a bear market during that time, 17%. So really ugly activity there in the oil patch. So be very careful there. I know the temptation is always to buy the dips and, you know, eventually it's got to work for you, right? But people who have had that mindset for the last couple of years have unfortunately been run over on the side. So you just have to be quite nimble if you're going to be trading in those energy markets and make sure that you've got your risk management defined in advance. In terms of any losers today, we only actually had one that I can see on the board, and that was consumer staples. It was barely down. It was down 0.11%. We did see Procter Gamble, by the way, come out with their earnings here in the last 24 hours. It finished higher, so it did its part. It was up 0.4% here today. But there were other areas there. I think like Phillip Morris, I think, hurt the staples today. Yeah, Phillip Morris. We don't talk about it a whole lot, but it's actually one of the largest consumer staples companies out there. Remember, this is the international division of the old Phillip Morris companies. So this is Phillip Morris International. If you're trying to trade, you know, the tobacco theme in the United States, you'd want to use ticker symbol MO for Altria. But you can see that Phillip Morris came out today, and boy, they must have really disappointed Wall Street. They were down nearly 6%. So I have a feeling that a big chunk of the reason that XLP was down today can be placed solely on the shoulders of Phillip Morris itself. Otherwise, we did have bullish price action across the board. Now, that's the good news. The bad news is many of our charts that we have in front of us have what we call long upper shadows. An example would be up here on the financials. And let me right click and maximize this chart so you guys can see this a little bit better. Notice that this candlestick right here has this long kind of line on top of the body. What that is signifying is that price of this security, which is XLF, which is the financials ETF, was trading much higher during one part of the day and then sold off for the second part of the day to finish in the lower half of its range. And a lot of times when you see those long upper shadows, it's a sign on an intraday basis that the bears started to win the battle, and the fear is that they might start trying to win the war. As an example, over here, we had a long upper shadow on XLF as well. Notice the very next day was a pretty nasty sell-off for XLF, a bearish engulfing candle right there. We also had a long upper shadow there. The next day we had a gap down. Over here we had a long upper shadow, and the next day we started kind of a multi-day decline. Here we had a long upper shadow and we fell the next day. Here we had a long upper shadow, we fell the next day. So it doesn't work like clockwork. It's just something to be aware of, and it is a sign of the psychology of the market that we didn't finish with a robust oomph the way that the bulls would want us to, despite us still being up a pretty healthy 0.8% in the case of XLF. And that was the case for a lot of the different charts that are out there. So we did not close on the highs in today's session. We want to be mindful of that going forward. All right, let's go ahead and get into our trade application example now. And for that, I'm going to come over here and just use chart 4A. This is our market forecast 1 grid for those of you that are following along at home. And remember that I've already placed the trade. The trade was already done during the normal market session. And I've already sent out all the trade details, including fill prices, on our Telegram alert service to those of you that are premium and plus members of Market Scholars. Kind of gives you a slight leg up in information above and beyond what folks that are just watching the free YouTube video would get. So make sure you're taking advantage of that if you're a premium member of Market Scholars. That trade alert system is not something we offer our plus members. They do get access to our trading rooms, but not the trade alerts themselves. So you do have to be a premium member of Market Scholars to be alerted not only of these trades that we're taking for the Market Outlook videos, but for all of our trades that we're taking for our 8 different trading rooms we teach each week as well. But anyway, the stock that I wanted to focus on was MDB. This is Mongodb, and probably not a name that everyone is familiar with, although if you've been trading in growth stocks in recent years, it may be one that has been on your radar a time or two. As an example, if I were to pull up, let's say, a 3-year chart on this, you can see what I mean. This has been a home run stock. It had a low price in the last 3 years here in 2017 at $24, and today it's a $256 stock. So it has been a real impressive growth company over time. Now, if I were to look at the current 1-year, 1-day chart here, you can see that after just hitting a new all-time high yesterday, we've actually had a pretty aggressive sell-off in the last 2 days in this stock. It hit $273 just yesterday at one point during the day. Today it closed at just under $257. And so when you have these really strong growth stocks like this, one way to try to apply your market forecast indicator knowledge is one of the signals called the bullish intermediate confirmation signal. It's the same signal I was mentioning when I was talking about the Russell 2000 earlier in this session. Well, you can see that that can exist on individual stocks as well. Down below here on the market forecast, you have the green line on Mongodb in the upper reversal zone. At the same time, you have the red line in the lower reversal zone. And so, in other words, we have a strongly bullish intermediate posture. In other words, this is still an upward trending security. At the same time, where we have a momentary sell-off, and that's what that red line is telling us there, in the near term. So hence the bullish intermediate confirmation signal. Now, as I've mentioned earlier with the Russell 2000 as well, while the blue line is not technically part of that signal, we do use it as an enhancement to the signal to try to gauge whether the setup's better or worse. And in this case, the blue line is between 50 and 20. In fact, it's kind of dead smack there in the center of it where you kind of want it. And so as I look at this chart, I recognize that there is a decent chance this stock continues to fall. After all, the upward trending moving average isn't until way down here at like 235 or thereabouts. So it could roll over for a few more days. Who knows? It doesn't have to stop on a dime here and then just immediately go higher. It's going to need to stabilize and then curl back higher once again. So this is not a situation where I wanted to go in and just buy the stock outright, knowing that, hey, there may be another $10 or $15 of downward price action, for all I know, in the coming days for this particular company. So I wanted to do a trade application that provided a little bit more flexibility there. So what I opted to do instead was sell the $210 put for the month of November. And, you know, I got around 1% return on risk for doing that. You can check the specific details once again on the Telegram app for those of you that are premium members. But that 210 level is somewhat attractive to me because it would be right back down in this kind of congestion zone that we have back here that stretches back all the way really since back in May. And so it seems like a place where if it were to fall from this level all the way to 210, there's probably going to be some buying support at around that level where we've seen that activity in the past. So is it risky? Yeah, it might be a bit risky, right? This is one of those more speculative, kind of cloud-based software companies that are out there. And as we all saw with Fastly last week, they can fall in a hurry under the worst of circumstances. Here's the good news. They've already reported their earnings. They're kind of off cycle. So the next time they report their earnings is likely going to be December 2nd, 3 months after the last time they reported here. And so that will be after the November contracts expire. So the good news is I've sold a put. We don't have to worry about holding that trade through an earnings announcement. The bad news is we do have an election coming up here in the United States, and some people might not feel comfortable with a sold put on a speculative stock like this with such a risky event on the horizon. So I'll leave that up to you. But in paper money purposes, we did sell the $210 put, and those trade details can be found there in the Telegram app for those of you that are premium market scholars. So that's what I had for you here today. I hope you got value out of the presentation. If you did and you want us to do these videos for you for free every single day on YouTube, you can do one simple thing for us. Take 5 seconds out of your day, click like for us there on Twitter. Thank you so much. And David should be back in the saddle there for you tomorrow. Until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.